Good afternoon, each and every one of us. I hope you're all doing great today. Our topic for today is all about PFRS 11 joint arrangements. Well, before we start our discussion, let me first introduce myself and my team. I am Cassandra Chanel L. Garcia, and I am with my assistant leader, Chanel Bautista, and the other members of our group, Ronaldo Cayabiab, Alessa Minoy, and Janelle Grace Urbano. So without further ado, let me have an overview or introduction about our topic. Joint arrangement. So first, I'll just give you a background about joint arrangement and kung anong nangyari sa mga standards or kung paano siya nag-evolve. So PFRS 11 joint arrangements is relatively used standard which was issued on 2011, and all entities must apply this standard for the period starting January 1, 2013. This standard replaced the old PAS 31 and interpretation SIC 13 non-monetary contributions by ventures. So these two are no longer valid. PAS 31, ang title nun is Investments in Joint Venture. Existing ito before January 1, 2013. Itong PAS 31 is meron siyang three types, which are the jointly controlled assets, jointly controlled operation, and jointly controlled entity. So starting January 1, 2013, napalitan na siya as PFRS 11 joint arrangements na meron na lang two types, which is the joint operation and the joint venture. So ang PFRS 11 is merong objective. The objective of PFRS 11 is to establish principles for financial reporting by entities that have an interest in arrangements that are controlled jointly, and that is joint arrangements. So in order to meet this objective, PFRS 11 defines joint control and then requires an entity that is a party to the joint arrangement to determine the type of joint arrangement which it is involved, because as I have said earlier, meron siyang two types, and based of the type, PFRS 11 prescribes the accounting method for entities' interest in the joint arrangement. So joint arrangement is an arrangement of which two or more parties have joint control. So arrangement ng two or more parties na may joint control. So two or more, hindi siya pwedeng mag-isa lang. Kasi nga, joint. So, ngayon, saan natin makikita yung joint control na yan? So, by definition of joint control is the contractually agreed sharing of control of an arrangement, which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing control. So, pag sinabing joint control, ang titignan natin is contractually agreed sharing. So, meron kang contract, and sa contract na yun is may agreement kayo na you will share control over yung relevant activities. So, may contract and also may unanimous consent. Unanimous consent saan? Doon sa relevant activities. So, first is dapat may contract, and syempre yung control na yan is contractually agreed sharing. Hindi pwedeng isa lang yung may control. Kasi pag isa lang may control, that would fall under PFRS 3 or PFRS number 10. So, syempre, pag nagkaroon ka na ng control, mag-isa mo, that is under your business combination, and later on, you will consolidate that under PFRS number 10. So, what do we mean by unanimous consent? Unanimous consent means any party can prevent any of the other parties from making unilateral decisions about relevant activities without its consent. So, dapat lahat mag-agree before mag-come up sa isang decision. Kung ano mang decision yan, investing decision, financing decision, or any decision that can affect the relevant activities. So, when we say relevant activities, these are activities that can significantly affect the returns of the entity or of the arrangement, not necessarily the entity, pero yung arrangement. So, dapat may unanimous consent. So, ano na ulit yung unanimous consent? Ito yung pinipigilan niya yung isang party na mag-act unilaterally or like magsolo siya. So, ibig sabihin nun, may decision na papasukin yung arrangement, yung mga parties na yan, dapat sana lahat sila ay, hindi. In some instances, not necessarily na lahat sila ay magde-decide or kailangan mag-approve or kailangan ng approval sa decision. Later on, na-explain natin or we will expound kung bakit hindi lahat ay need ng approval through some examples. So, ang unanimous consent ba is the same sa unanimous decision? Obviously, from the words pa lang na ginamit is mag-iba na. So, normally, a unanimous decision is maririnig natin sa mga boxing or MMA. And iba siya sa unanimous consent na sinasabi dito sa joint arrangement. Ang unanimous decision is normally may mga judges, and pag sinabing unanimous decision, lahat ng judges na yon is in favor sa isang particular fighter. Lahat sila is pantay-pantay sa pagde-decide. Pero sa joint arrangement, when we say unanimous consent, not necessarily na lahat sila and sa isang company, they can divide the ownership or yung interest na hindi pare-parehas. Ganun yung sa unanimous consent sa joint arrangement. So, ang keywords natin dito is at least 2 or more. Merong contractually agreed sharing of control. Merong unanimous consent sa mga relevant activities. So now let's move on to some examples ng joint control. 3 parties establish an arrangement with the following voting rights. The contractual arrangement between A, B, and C specifies that at least 75% of the voting rights are required to make decisions about the relevant activities of the arrangement. So, si A, meron siyang 50% voting rights. Si B, merong 30%. And si C, merong 20%. So, ang tanong, merong bang joint control dito? The answer is yes, merong joint control between A and B. Kailangan nilang makabuo, di ba sabi sa problem, kailangan ng 75% voting rights. And pag nag-agree si A and B, meron ng 80%. Pag hindi nag-agree si A, magkakaroon lamang ng 50% mostly at most na voting rights. Kasi si B, meron siyang 30, si C, merong 20. So, hindi matutuloy. Pag hindi nag-agree naman si B, magkakaroon ka lang ng 70% kasi si A 50, si C is 20%. And pag hindi naman nag-agree si C, okay lang kasi meron ka namang 80% from A and B. So merong joint control between A and B. Next example. An arrangement has 3 parties. A 50%, B and C each have 25%. The contractual arrangement between A, B, and C specifies that at least 75% of the voting rights are required to make decisions about the relevant activities. So, ayan, si A merong 50, si B merong 25, si C merong 25%. So, meron ka bang joint control dito? The answer is pwede, joint control between A, B, and C. However, sabi dito, contractual arrangement would need to specify which combination of the parties is required to agree unanimously for it to be classified as joint arrangement. So magiging joint arrangement siya kung yung contract behind this will specify kung ano ba yung combination na dapat mag-approve. Is it A and B or A and C? So pwede siyang maging joint control between A and B or joint control between A and C. So the following diagram illustrates the key criteria to be met for an arrangement to be classified as a joint arrangement. So para malaman mo kung within the scope of PFRS siya, PFRS 11 siya, tingnan natin. Thus, the contractual arrangement give all the parties or a group of the parties control of the arrangement collectively. If no, outside the scope of PFRS 11. If yes, tignan natin ulit. Do decisions about the relevant activities that significantly affect the returns of the arrangement requires the unanimous consent of all parties or a group of the parties that collectively control the arrangement. So, ando na naman yung may sharing of control, may unanimous consent. So if no, outside the scope of PFRS 11. And if yes, it is within the scope of PFRS 11. The arrangement is jointly controlled. Therefore, the arrangement is a joint arrangement. Types of joint arrangement. So, if it is within the scope of PFRS 11, tignan mo na kung anong type of arrangement siya. Is it joint operation or JV, joint venture? So, joint operation parties have rights to the assets and obligations for the liabilities relating to the arrangement. Those parties are called joint operators. Joint venture naman, parties have rights to the net of the arrangement. Those parties are called joint venturers. So at first glance, if we will check the definition ng dalawa, parang the same sila. Pero pag titignan nating mabuti, meron silang difference. So after ng rights, meron na silang konting difference. So ang pinagkaiba nila, pag sinabi mong joint operations, the parties have direct rights to the assets and direct obligations for the liabilities. Tapos ang tawag mo sa parties na may control sa joint operation is joint operators. For JV naman or joint venture, wala kang specific rights sa specific assets or wala kang specific obligations sa specific liability. Rather, meron kang rights to the net assets as a whole. So, ang tawag mo sa parties na may control sa joint venture is joint venturers. So, pag may rights sa assets and obligations sa liability, ang tawag natin dyan is joint operation. Pero pag yung right mo naman is sa net assets, ito naman yung tinatawag nating joint venture. So in short, pag joint operation, na-identify mo kung ano-anong assets ang own mo. Yung bang asset na nasa left is kay joint operator letter A. Yung assets na nasa right is kay joint operator letter B. Or yung layag mo kay creditor A, is it the liability of one of the joint operator. So kapag specific assets or specific liability yung interest doon sa joint arrangement, that is joint operation. Pero kapag net assets, buo na, isahan na yung interest mo doon sa vehicle na yun, that is joint venture. So joint ventures are always structured through a separate vehicle. So kapag di mo na alam kung ano yung specific sa'yo, kunwari 50% of net assets I own ko under my interest, that is a joint venture. Rights and obligations arising from the arrangement. So yun, sinasabi natin kanina, pag assets and liabilities, joint operation. Pero pag net assets as a whole, it is joint venture. So what to consider? So ano nga ba ang mga dapat mo i-consider para malaman mo kung yung joint arrangement is a joint operation or joint venture? So number 1, the rights and obligations arising from the arrangements. Number 2, assessing the rights and obligations in relation to the structure and legal form of the arrangement, terms of the contractual arrangement, and other facts and circumstances. Kasi maaring pumasok siya as joint venture, pero along the way parang ma-analyze mo na, teka, parang joint operation to. So the first step, pag na-encounter mo to, is to classify if the transaction is actually a joint venture or a joint operation. Why? Kasi magkaibang accounting procedures nila. So ito yung mga dapat mong i-consider. So, another concept dito sa PFRS 11 is yung tinatawag natin na separate vehicle. And when you say separate vehicle, mas malawak ang scope ng separate vehicle as compared sa tinatawag natin na entity. And by the definition of separate vehicle, it is a separately identifiable financial structure, including separate legal entities or entities recognized by statute, regardless of whether those entities have a legal personality. So example, ito is nakapasok siya sa isang limited partnership. Nasa corporation form siya or kaya naman nasa financial institution siya. Either way, separate vehicle description nun. Entities considered a separate vehicle, kaya lang when you say separate vehicle, pwedeng recognized ng company yan under our law or pwedeng hindi din. So without or not structured through a separate vehicle, that is a joint operation. Pero kapag assets or liabilities are held in a separate vehicle, pwede siya maging joint venture or pwede siyang maging joint operation. So, paano malalaman kung joint operation siya or joint venture? Tignan natin tong 4-step process. So, is the joint arrangement structured through a separate vehicle? When you say separate vehicle, it is either separately incorporated entity or a division of an entity that maintains its own books, or may sarili siyang own book or separately incorporated siya. That is a separate vehicle. Pag di siya separate vehicle, automatically joint operation siya. Pero kapag separate vehicle siya, tignan mo na yung legal form, term of agreement, and other facts and circumstances. Yung tatlong yun, it indicates ba na yung investors is may direct rights sa assets and direct obligations sa liabilities. So, pag meron siyang direct rights sa assets and direct obligations sa liabilities, is joint operation siya. Pero pag hindi, or pag wala, joint venture. So, itong 4-step process. So, kapag no, ito is joint operation. Pero pag yes, ito na yung sinasabi natin na either joint operation or joint venture. And may kasunod na tanong dapat. Does the legal form of the separate vehicle confer upon the parties direct rights to assets and obligations for liabilities relating to the arrangement? So, if may rights daw over the assets and obligations sa liabilities, pag yes, nagpo-fall siya sa definition ng joint operation. Pag no, ang sagot mo, may additional question ulit. Do the contractual terms between the parties confer upon them rights to assets and obligations for liabilities relating to the arrangement? So, kanina legal form. Ngayon, check mo yung contractual agreement nila or the contractual terms. Did it confer the rights to assets and obligations to liability? Pag yes, automatic joint operation siya. Pero kapag no, another question ulit. Do other facts and circumstances lead the rights to assets and obligations for liabilities being conferred upon the parties to the arrangement. If yes, joint operation, and if no, it is a joint venture. So next presenter will be Chanel Bautista to discuss to you more what is a joint operation.
Hi guys, welcome to my vlog. Char lang. Okay, start na tayo. So, joint operation is one of the types of joint arrangement. Joint operation means that the party has a joint control to the arrangement and the party has a right to the asset and an obligation to the liability. But guys, let's dig deeper about joint operation. So, the parties or the joint operator is required to recognize their interest in a joint operation. In other words po, the joint operator must recognize their own assets, liabilities, income, and expenses plus yung share nila doon sa assets, sa liability, income, and expenses doon sa kanilang joint operation. Second, joint operation applies direct accounting of assets and liabilities. And joint operation may or may not be used separate books of accounts. Okay? Pagdating naman natin sa financial reporting ng joint operation, ganito ang ginagawa nila. So illustration number 1. A and B agreed to acquire and jointly operate an oil pipeline that each will use to transport its own oil. The joint operators will share equally in the pipeline's acquisition and operating costs. The acquisition cost was 100 million and the operating costs were 30 million. A and B had the total sales of 120 million and 150 million respectively. So meron silang stipulation, agreement, share equally daw sila sa pipeline acquisition and operating costs. Pipeline is a non-current asset under Statement of Financial Position. So, PPE account, acquisition cost ng 100 million ng pipeline, multiply natin yan sa 50% because share equally. So, both parties po is meron silang 50 million sa kanilang PPE account under Statement of Financial Position. Pagdating naman natin sa Statement of Profit or Loss, sa sales, wala namang agreement. So yung buong 120 million na sale ni A is buong buo po niya yung i-recognize sa kanyang libro. And yung buong 150 million naman na sale ni B is buong buo niya rin niya i-recognize sa kanyang libro. So they don't need to add their sales and then multiply it by 50% because there's no agreement about it. Yan yung sinasabi ko sa inyo kanina na joint operators must recognize their own assets, liabilities, income, and expenses. Yan yung own. Okay? Pagdating naman sa operating costs, expenses yan, 30 million multiplied by 50%. So, entity A and entity B have a 50 million sa kanilang expense account. Yan naman yung plus yung share nila doon sa asset, liability, income, and expenses. Yan yung share. Okay? Na i-recognize nila. So entity A had the profit of 105 million and entity B had the profit of 135 million. So next is accounting for joint operation. Dito, separate accounting records may or may not be required for the joint operation itself. And financial statements may or may not be prepared for the joint operation. In other words, separate books of accounts, such as journals and ledgers, may or may not be used. And also, financial statements may or may not be used and prepared in the joint operation. So, depende po yan sa mga parties. Kung gusto nilang gumamit ng separate books of accounts, gusto nilang mag-prepare ng financial statements, depende po yan sa napag-usapan nila sa kanilang contractual arrangement po. However, guys, the joint operators may prepare management accounts. Yung management accounts, yan ay joint operation account po. Ginagamit nila yan to assess the performance of the joint operation. Next is the following or the considerations in accounting for joint operation. So first, no separate records are maintained for the joint operation. Ibig sabihin lang yan na yung joint operation po is wala siyang sariling libro na pagre-recordan ng kanyang transactions. Second, separate records are maintained for the joint operation. Ibig sabihin na yung joint operation is meron na siyang sariling libro at ang tawag doon sa libro niya ay Joint Operation Books or JO Books po. But, mas uunahin natin ang no separate records or maintain. Dahil wala itong libro na pagre-recordan ng sarili niyang transactions, ang mangyayari dyan, the joint operation transactions are recorded in each of the individual books of the joint operators. So, bawat transaction na mangyayari, ire-record po yan ng bawat parties sa kanilang individual books using the joint operation account. Ito po, ang nature niyan is income summary account. I want you guys to remember this, itong T account, kasi gagamitin natin yan mamaya. Okay, tandaan nyo yung mga relationship ng bawat account sa isa't isa, okay? So, pansinin natin itong T account. Yung mga accounts na nandito sa debit side ay may normal balance po na debit. Tulad nitong merchandise contribution, purchase and fit-in, sales return and discount, which is a contra income, and then expenses. Pagdating naman sa credit side, yung mga accounts na nandyan is meron po silang normal credit balance po. Tulad ni merchandise withdrawals, purchase return and discount, sales and other income, and yung unsold merchandise po. Kaya po yan nandyan sa credit side kasi nire-reflect niya po ang cost of goods sold. In computing the cost of goods sold po kasi, beginning inventory plus purchases, ilaless natin yung purchase return and discount, i-add natin yung fit-in, tapos ilaless natin yung unsold merchandise or the ending inventory to get the cost of goods sold. Okay? Pag mas malaki ang amount dito sa credit side at meron tayong credit balance, ibig sabihin may profit. Pero kung mas malaki ang amount sa debit side at meron tayong debit balance, ibig sabihin meron tayong loss. Remember guys, na kapag debit balance, loss. At kapag credit balance naman, ay profit. Okay?
So, hindi lang joint operation account ang ginagamit sa joint operation. Gumagamit din po sila ng personal accounts such as receivable from a joint operator and payable to a joint operator. But they can also use account titles such as account with A, account with B, or simply A cost and B cost. A credit balance in such account, it represents payable po. And a debit balance naman po in such accounts, it represents receivable. Sa joint operation, pwede po sila magkaroon ng one or more manager. So, depende po yan sa kanila kung ilan po yung manager na gusto nila. And usually, yung na-appoint na manager is binabayaran po siya ng management fees.
Yung management fees po is treated yan as expense sa joint operation and income naman po yan sa manager. Siyempre, si manager ang tatanggap. Okay, kaya income. But guys, remember this, okay? Na pag kayo ang manager records any assets other than merchandise and any liabilities he receives or incurs on the behalf of joint operation using regular accounts but labeled as JO. So kung tayo ang manager, pwede tayong mag-record ng kahit anong asset other than merchandise and kahit anong liability using regular accounts. Regular accounts such as cash, accounts receivable, and accounts payable, and so on. Pero kailangan nating i-label dyan as JO. For example, JO cash, JO accounts receivable, and JO accounts payable. Kasi kung iisipin din naman natin, si manager ang may responsibility in managing the operation of joint operation. Tapos, no separate records or maintain. So, ibig sabihin, ire-record niya bawat transaction sa sarili niyang libro. So, para maiwasan yung pagkahalo ng pera ni manager at yung pera ng joint operation, tama lang naman na i-label niya as JO yung mga gagamitin niyang regular accounts. Diba? That's it. And now, i-apply na natin lahat ng sinabi ko kanina. So, case number 1 tayo. No separate books maintained. A, B, and C form a joint operation. The following were the joint operation transactions. So, A to F po yan. Mamaya ko na babasahin yan pag gagawa na tayo ng journal entries. So, dito na agad tayo sa additional information. So, first, all inventories were sold except 1/3 daw from C's purchases. And C was charged for the cost of the unsold inventory. The joint operators agreed on the following. So, first agreement nila, C is entitled to a management fee of 6 pesos and a bonus of 15% of profit after. Okay, remember guys, profit after management fee and bonus po. And second agreement, any remaining profit or loss is divided daw equally. Okay, so requirements natin, prepare the journal entries for transaction A to F. Requirement B, compute for the profit after management fee and bonus. Requirement C, determine the cash settlements to the joint operators. So, unahin muna natin yung requirement letter A, journal entries. So, A, B, and C form a joint operation. The following were the joint operation transactions. So, transaction letter A. A, transfer cash of 100 pesos to C, the appointed manager, representing A's contribution. So, anong journal entry natin dyan? Sa libro ni A at ni B, nag-debit sila ng joint operation account na 100 pesos. Pero pagdating sa libro ni C, nag-debit siya ng JO cash kasi C is the appointed manager and cash is not a merchandise.
Recall lang po natin that the manager can record any asset other than merchandise using regular accounts but labeled as JO. Kaya po nakadebit ang JO cash. Sa libro ni A, credit cash. Sa libro ni B at ni C, credit payable to A. Kasi pag hindi nag-push through or hindi natuloy ang joint operation o kaya naman hindi nagamit yung kinontribute na pera ni A, ibabalik po yan ng joint operation kay A. At kung mapapansin natin, si B hindi naman siya involved sa transaction, ni hindi siya na-mention, pero nag-record siya. Ganun po kasi talaga sa no separate books maintained. Kasi at the end o kaya pag na-complete na ang joint operation, dapat yung joint operation account ng bawat parties is magtatali. Ibig sabihin, dapat parehas ng amount, dapat balance. At kung hindi yan balance, kinakailangan po nila magkaroon ng reconciliation.
So, transaction letter B na tayo. B contributed inventories worth 120 pesos. So, sa libro ni A, B, at ni C, nag-debit po sila ng joint operation account na 120 because doon sa ating T account, merchandise contribution is nasa debit side po. Kaya joint operation account is debited.
Sa libro ni B, credit inventory. Sa libro ni A at ni C, credit payable to B. Kasi pag hindi nag-push through, hindi natuloy ang joint operation o kaya naman hindi na ibenta yung mga kinontribute na inventory ni B, ibabalik po ng joint operation yon kay B, kaya payable to B. So, transaction C na tayo. C contributed cash of 80 pesos. So, journal entries. Sa libro ni A at ni B, debit joint operation account na 80 pesos. Sa libro ni C, which is the manager, debit JO cash. Na-explain ko na yan kanina. At nag-credit siya ng cash kasi nag-contribute siya ng pera sa joint operation. Sa libro ni A at ni B, nag-credit sila ng payable to C. Na-explain ko na rin yan kanina. So, transaction letter D na po tayo. C purchased inventories worth 160 and paid freight of 20 pesos using the cash contribution. So, journal entries po natin dyan. Sa Libroni C, debit joint operation account na 180 pesos. Kasi dun sa T account natin kanina, ang purchases at freight-in is nasa debit side. That's why joint operation account is debited. At nag-credit siya ng JO Cash. Kasi yung ginamit niyang pera sa pambili ng inventories at pagbayad ng freight ay pera po ng joint operation. Kaya po, JO Cash is credited. Sa libro ni A at ni B, no entries na po yan because the cash used in the purchases and freight-in is already reflected na po sa libro ni A at ni B. Kung matatandaan natin doon sa transaction letter A at transaction letter C, nag-debit na po sila ng joint operation account. Samantalang si C, JO Cash po ang kanyang idinebit. So, transaction letter E, C made cash sales of 900 pesos. So, journal entries natin dyan. Sa libro ni C, debit JO cash na 900. Sa libro ni A at ni B, debit receivable from C. Kasi yung pera na natanggap ni C is pera po yun ng joint operation. That's why receivable from C is debited. Sa libro naman ni A, B at ni C, credit joint operation account na 900 because sales and other income is nasa credit po yun ng T account ng joint operation account. Transaction letter F. C paid expenses of 240 pesos from the JO Cash. So journal entries, sa libro ni A, B at ni C, debit joint operation account na 240 because expenses is debited doon sa T account ng joint operation account. At pagdating sa libro ni A at ni B, credit receivable from C because by paying the expenses out of JO Cash, C's cash accountability is reduced. That's why receivable from C is credited. At JO Cash is credit naman sa libro ni C. So tapos na tayo sa journal entries. Now we will compute for profit after management fees and bonus which is requirement letter B. So dito, gagamit tayo ng T account ng joint operation account. Kaya sabi ko sa inyo kanina, natandaan ninyo yung T account because we will use it here. So sa debit side, meron tayong merchandise contribution na 120 pesos. Yan yung kinontribute ni B kanina na inventories. And then purchases and freight-in na 180 pesos. And then expenses na 240. Pagdating sa credit side, meron tayong 900 pesos na sales and then 60 pesos na unsold merchandise. So, paano ba natin nakuha yung unsold merchandise? Sabi sa problem kanina na all inventories are sold except 1/3 of C's purchases. So, magkano ba yung purchases ni C? So, meron siyang 160 na purchases plus natin yung 20 pesos na freight-in is equals to 180. Multiply natin yan sa 1/3 which is hindi pa daw na ibebentang merchandise. So, meron tayong 60 pesos na unsold merchandise po. That's why joint operation had a profit before fee and bonus na 420 pesos. But we will compute more to get the profit after management fees and bonus. So, profit before fee and bonus, less natin ang management fee ni C na 6 pesos is equals to 414 na profit after fees but before bonus. So, kailangan pa nating i-less yung bonus dyan which is 54 pesos. Pero paano nakuha yung bonus? Gagamit tayo ng formula which is P minus P, divide natin sa 1 plus BR. So, yung P stands for profit after management fees but before bonus and then yung BR naman stands for bonus rate. So, 414 minus 414, divide natin yan sa 1.15 is equals to 54 pesos. So, para makuha yung profit after management fee and bonus, profit before management fee and bonus na 420, less natin yung 6 pesos na management fee, less din natin yung bonus ni C na 54 is equals to 360 na profit after management fee and bonus. Next is requirement C. cash settlement. So dito, i-compute natin yung matatanggap na pera ng mga joint operators o kaya naman yung babayaran nila. So depende yan. Sabi dito, the joint operation is liquidated. Siyempre, hindi naman kasi permanent ang joint operation. Nabubuo lang yan for a specific task or for a relevant activity. For example, to build a bridge. Kadalasan, pagkatapos na build yung bridge, nagle-liquidate na sila. So, it's not a permanent. Okay? Sabi dito, the cost of the unsold inventory na 60 pesos is charged daw kay C. How much are the cash settlements to the joint operation? So, dito sa cash settlement, may dalawang step yan. Which is step number 1, allocate the profit or loss. So, yan ang unahin natin. Profit before management fee and bonus na 420, i-allocate natin yung management fee na 6 pesos and then yung bonus sa 54 ni C. So, 420 minus 6 pesos minus 54 na bonus is equals to 360. Yung 360, yan yung remaining profit. Sabi sa problem kanina, additional info, any remaining profit is divided daw equally. So, dahil tatlo sila, i-divide natin yan sa tatlo. Sa 3. So, 360 divide 3 is equals to 120. So, si A, meron siyang share sa profit na 120 pesos. Si B, may share sa profit na 120 pesos. And then si C, meron siyang share sa profit na 180 pesos. Kasi 120 plus 54 plus 6 is equals to 180 pesos. Next is punta na tayo sa step number 2, which is make the accounts. Dito, meron tayong dalawang pwedeng gamitin na account, which is the personal accounts and the joint operation account po. Ito. So, depende yan sa inyo kung anong gusto nyong gamitin or depende sa hinihingi ng problem. So, unahin natin itong personal accounts. So, payable to A, payable to B, payable to C, and receivable from C. Yan yung mga ginamit natin kanina. Yung payable to A, makikita natin yung account na yan sa libro ni B at saka ni C. So, dito, sa credit side, yung 100 pesos, yan po yung cash contribution ni A kanina. And then, itong 120, yan naman po yung share niya sa profit. So, meron po siyang 220 na cash receipt. Guys, tandaan ninyo na kapag gagamit kayo ng personal accounts, ang cash receipt po is nasa credit side po. Pag meron po kayong credit balance, cash receipt po yon. At pag may debit balance naman, cash payment. Okay? Hindi siya tatanggap ng pera. Bagkus siya ang magbabayad pag debit balance po. Okay? Tandaan nyo, sa personal accounts, credit balance, cash receipt. Debit balance, cash payment. Payable to B, makikita natin yung account na yan sa libro ni A at saka ni C. So, 120. Yan yung kinontribute niyang inventory. Tapos, 120 din yung share niya sa profit. So, meron siyang 240 na cash receipt. Payable to C, A's and B's book natin makikita. So, ito yung 80, yung kanyang cash contribution kanina. And then, 180 na share niya sa profit. And then, yung 60. Bakit may 60 siya dyan sa debit? Kasi sabi dito, the cost of unsold inventory na 60 pesos daw is charged to C. So, sa kanya daw, chinarge. So, the ending inventory or the unsold inventory na cost is nandito, 60 pesos. So, meron po siyang receipt na 200 pesos po. Itong mga to, yan po yung matatanggap nilang pera. Yan yung cash settlement na tinatawag natin.
Next is receivable from C. So, nag-debit tayo ng 900 pesos. Yan yung napagbentahan kanina. Yan yung sales. And then, credit 240 na expenses. Because by paying expenses out of JO cash, C's cash accountability is reduced. So, nabawasan po yung marireceive ng mga joint operators. 900 minus 240, may payment na po na 660. C is the manager and the holder of the JO cash, pays A and B a total of 460 because 220 na receipt ni A and then 240 na receipt ni B is equals to 460 po. So, C's net share
on the settlement of the joint operation is 200 pesos po. So A, B, and C will receive cash of 220 pesos, 240 pesos, and 200 pesos respectively.
So next, joint operation account. Parehas lang naman sila. Kaso nga lang, kapag gagamit kayo ng joint operation account, pag debit balance, cash receipt. Pag credit balance naman, cash payment. Di ba kanina, sa personal accounts, ang ating cash receipt is nasa credit side. Ang ating cash payment is nasa debit.
Pagdating sa joint operation,
Kabaliktaran siya. Okay? A debit balance means a cash receipt. So kapag credit balance yan, cash payment. Okay, tandaan nyo yan ha. So dito, reflecting only the joint operators net contribution and share in profit. Ito yung contribution ni A kanina na 100 pesos na cash. Tapos share yan sa profit ng 120, so meron siyang cash receipt na 220. Tapos si B, ito yung net contribution niya. Ito yung share niya sa profit, so meron siyang cash receipt na 240. At si C, ito yung contribution niya, yung share niya sa profit, tapos yung charge sa kanya na cost ng unsold merchandise na 60 pesos. So may cash receipt siya na 200. Parehas lang yung ikakarga nila. Kaso nga lang, pagdating na sa cash receipts, debit balance po sa joint operation. At credit balance naman po ang cash receipt sa personal accounts. Pagdating dito sa JO Cash, checking lang po ito. Ito, checking lang siya. So, sa JO Cash, nag-contribute si A kanina ng pera. So, 100, debit yan. Siyempre, nadagdagan ang JO Cash. Tapos, nag-contribute din si C ng 80 pesos na pera. Tapos, nagkaroon ng cash sales na 900. Pero, nagkaroon din tayo ng pagbabayad, which is yung purchase and fleet in natin na 180. Tapos, yung expenses natin na 240 at ibawas din natin dito sa JO Cash yung cash settlement ni A at saka ni B na 220 and 240. So bakit hindi na sinama sa pagbawas sa JO Cash yung cash settlement ni C? Hindi na po natin ibabawas yan kasi si C po ang may hawak ng pera. So ibig sabihin nun, mare-retain na po kay C yung tira, which is yung 200. Tignan nyo. Di ba? Okay. So, separate records or maintain na tayo. So, dito, syempre, mas madali na to.
kasi hindi mo na kailangan mag-record doon sa individual books ng mga parties. Directly mo na itong ire-record sa libro ng joint operation.
So, interest in a joint operation. Ang nature nito, para siyang investment. Pag kayo ay nagkaroon ng contribution and investment, nasa debit po yan. Ito. Tapos, pag kayo ay nagkaroon ng costs and expenses paid for the joint operation, debit. At pag ang share nyo ay profit, debit side. Pero pag share in loss in a joint operation, credit side po yan. Tapos, sale and other income received, credit side din yan. Withdrawals of contribution or investment, nasa credit side din. So, sa separate records or maintain, joint operation transactions are recorded in those separate books in a regular manner. Ibig sabihin lang yan, para na siyang ordinary business. Hindi ka nagagamit dyan ng mga personal accounts. Ito sabi, personal accounts and JO Cash or similar accounts are not used. Okay? Kasi regular manner na. Like an ordinary business, guys. Tapos sabi niya dito, the joint operators record only their own transaction and their respective books. So, hindi na po kailangan na mag-record ang bawat parties ng transaction doon sa joint operation sa kanilang individual books. Ang ire-record lang po nila is yung sarili nilang transaction na kung saan involved sila sa joint operation. So, ito. Separate books maintained. Case number 2, parehas lang yan dun sa kanina na problem. Pero, para mas malaman natin yung difference ng separate books at saka no separate books. So, A, B, and C form a joint operation The following were the joint operation transactions. So A to F yan. Mamaya ko na din yan basahin pag gagawin na tayo ng journal entries. Additional information, all inventories were sold except 1/3 from C's purchase. C was charged for the cost of unsold inventory. The joint operators agreed on the following. So first agreement, C is entitled to a management fee of 6 pesos and a bonus of 15% of profit after management fee and bonus. Second, any remaining profit or loss is divided daw equally. So requirements natin, requirement A, prepare the journal entries for transaction A to F. Requirement B, compute for the profit after management fee and bonus. Requirement C, determine the cash settlements to the joint operators. So requirement A tayo. A, B, and C form a joint operation. The following were the joint operation transactions. So transaction letter A transferred cash of 100 pesos to C, the appointed manager, representing A contribution. So journal entry natin, sa libro ni A, dahil siya ay nag-transfer ng pera at transaction niyan between A and the joint operation, syempre, kailangan mag-record ni A. So debit joint operation account na 100 pesos and credit cash na 100 pesos. Itong joint operation na ginamit niya dito, diba? Sabi ko sa inyo kanina, yung interest in a joint operation para siyang investment. Kaya yan nandito. Debit. Pagdating naman sa JO Books, yan yung libro na ng joint operation. Kasi meron ng sariling libro ang joint operation. Congrats. So debit, cash, kasi naka-receive po ang joint operation ng pera. And then credit, A capital. Sabi ko sa inyo, para siyang investment. Kaya A capital po yan. Okay? Ng 100. Sa libro ni B at ni C, no entry po. Kasi hindi naman sila involved dun sa transaction eh. So, no entry. Wala silang pakialam dyan. Transaction letter B. B contributed inventories worth 120 pesos. So, journal entries natin. Sa libro ni B, debit joint operation of 120. Kasi po, merchandise po yan eh. Joint operation 120 and credit inventory of 120. Sa JO Books, debit inventories of 120 and credit B capital na 120. Sabi sa inyo, para siyang investment. Kung mapapansin nyo, regular manner na tayo nag-entry para ng ordinary business. So, mas madali siyang intindihan compare doon sa no separate books. So, transaction letter C na tayo. C contributed cash of 80 pesos. So, sa libro ni A at ni B, no entry po ulit. Kasi, hindi sila involved. Sa libro ni C, debit joint operation of 80 pesos and credit cash of 80. Kasi nag-contribute siya ng pera. Pagdating sa JO Books, debit cash. Kasi nakatanggap ang joint operation ng pera. And then credit C capital of 80 pesos. So, transaction letter D. C purchased inventories worth 160 and paid fleet of 20 pesos using the cash contribution. So, journal entry natin dyan. Sa libro ni A, B at ni C, no entry po. Bakit? Hindi naman po sila involved. Okay? Kay joint operation lang po yan. So, JO Books, debit purchase of 180 and credit cash of 180. Although nabanggit yung pangalan ni C dyan, hindi naman ibig sabihin na transaction niya yan, na involved siya dyan. Remember guys, na si C po ang manager. So siya ang nagmamanage ng operation ng joint operation. Pero hindi niya transaction yan. So hindi niya kailangan mag-entry. So transaction letter E, C made cash sales of 900. So ang ating journal entry dyan, sa libro ng joint operation, debit cash of 900, nakatanggap ng pera, and then credit sales of 900. So transaction F, C. Paid expenses of 240 from the JO cash. Hindi ibig sabihin na JO cash, sabi niya dyan, is ang gagamitin yung account title is JO cash din Sinasabi niya lang na pera ng joint operation yung ginamit na pambayad ng expenses. So sa JO books, debit expenses of 240 and credit cash na 240. Sa libro ni A, B, and C, no entry po dyan. So next, requirement B na tayo. Profit after management fees and bonus ang ating hahanapin. Paras lang yan dun sa kanina. Pero ang gagamitin natin dito is ito. So sales, magkano ang sales natin? 900. So compute natin ang cost of goods sold. Ang ating beginning inventory, 120. Magkano ang purchases natin in fit-in? 180. Ito yung kanina na purchase in fit-in. So, 120 plus 180. So, may tanong tayong 300 na total goods available for sale. Tapos, less natin yung inventory ending na 60 pesos. So, meron tayong cost of goods sold na 240. So, 900 na sales, less natin yung cost of goods sold is equals to gross profit na 660 pesos. Less din natin yung expenses na 240. So, equal siya sa profit na 420. Okay? Paano nakuha yung 60? Di ba sabi sa additional info kanina na all inventories are sold except 1/3 of C's purchase. So, 160 purchase plus 20 na fit-in. So, 180 po ang purchase kanina. Multiply natin yan sa 1/3. So, meron 60 pesos na unsold merchandise. Itong 420, tulad kanina, ang tawag dyan ay profit before management fees and bonus. Hindi ko lang nasulat dito. Pero yun ang tawag. So, mag-compute pa tayo to get the profit after management fees and bonus. So, profit before management fee and bonus, 420. Tapos, less natin yung management fee na 6. Less natin yung bonus na 54. Pero, paano nakuha yung bonus? So, tulad din kanina, gamitin natin yung formula, which is P minus P. Divide natin sa 1 plus BR. P stands for profit after fees but before bonus. Ito yon. And then BR stands for bonus rate. So, 414 minus 414, divide natin siya sa 1.15 is equals to 54 po na bonus. Ito yan. So, profit before management fee and bonus na 420, i-less natin yung management fee ni C na 6 pesos and then yung bonus ni C na 54. So, equals po, meron tayong 360 na profit after management fee and bonus. So, requirement, C na tayo. Cash settlement. Kung mapapansin nyo, parehas lang. Yes, parehas lang po. In computing the cash settlement, 2 steps din. Allocate the profit or loss, tapos yung make the accounts. Pero unahin natin tong step number 1. Allocate natin yung profit or loss. So, profit before management fee and bonus na 420. Tapos, i-less natin yung management fee na 6 pesos. I-less natin yung bonus na 54. So, 420 minus 6 minus 54. So, meron tayong 360 na remaining profit. Anong sabi sa problem kanina? Dun sa additional info, any remaining profit is divided daw equally. So, 360 divide 3 kasi tatlo sila. So, entity A, meron siyang share sa profit na 120. Si entity B, 120 din. Si entity C, meron siyang share sa profit na 180. Paano nakuha yan? 120 plus yung 54 na bonus plus yung 6. So, 180. So, step number 2, make the accounts. So, meron din silang dalawang accounts na ginagamit dito, which is the capital account and the joint operation account. Okay? Sa capital account, para rin siyang personal accounts na ang kanilang cash receipt is nasa credit side. So, ibig sabihin lang na pag meron itong credit balance, cash receipt. Pag meron itong debit balance, cash payment. Okay? So, A capital, nagkaroon siya ng contribution na 100 pesos. So, credit po yan. And then, magkano yung share niya sa profit? 120 pesos. So, meron po siyang receipt na 220. Pagdating sa B capital naman, nag-contribute si B ng 120 na inventory. And then, share niya sa profit is 120 rin. So, meron po siyang receipt na 240. Yan yung matatanggap nilang pera. Pagdating kay C, meron siyang contribution na 80 pesos na pera sa joint operation. And then 180 naman na share niya sa profit. And then 60 na ending inventory. Kasi sabi dito, the cost of the unsold inventory, 60 pesos is charged to C. So, 60 pesos charge kay C. Kaya meron siyang cash receipt na 200 pesos. Pagdating sa joint operation account, dito reflecting only the joint operator's net contribution and share in profit. So, ang cash receipt po natin dito sa joint operation account is nasa debit balance. Okay? At ang ating cash payment is nasa credit. Tandaan nyo yan, ha? Pag joint operation account, ang gagamitin natin, ang cash receipt is nasa debit balance. Pag yan ay credit balance, cash payment.
Pero sa capital account, ang cash receipt ay nasa credit balance at ang cash payment ay nasa debit balance. So kabaliktaran po siya ng joint operation account.
So joint operation account, 100 na contribution ni A, 120 na share niya sa profit. So meron siyang cash receipt na 220. Diba doon sa interest in a joint operation, yung sabi ko kanina, ang nature niya is investment. Pag share in profit, nasa debit side. Ito yun, no? Debit side, 120. Kasi debit. Kasi profit ang kanyang share. Okay? Pagdating sa joint operation ni B, may contribution siya na inventory na 120, tapos share niya sa profit 120, so meron siyang cash receipt na 240. Kay C naman, 80 na contribution, 180 na share niya sa profit, and then yung chinarge sa kanya na cost ng unsold merchandise sa 60 pesos dito. So, meron siyang cash receipt na 200. Tapos ito, tulad din kanina, checking lang natin yan. Cash contribution from A, 100. And then, cash contribution from C, 80. Tapos yung cash sale na 900. Tapos sa credit side, yung mga kabawasan doon sa cash. Yung cash purchase and fit-in, yung expenses na binayaran kanina. And then yung cash settlement ni A at saka ni B na 220 and 240. And then yung tira is mareretain yan kay C. Kasi si C ang manager at siya yung may handle ng pera. Kaya mareretain na lang sa kanya yung tira. Next is additional tayo ng illustration. Dito naman, reconstruction of the account naman ito, unsold inventory. So A, B, and C. C's joint operation has just ended. Okay, natapos na daw. B, the appointed manager had the following accounts in his books before closing entries. Ito. Ito daw yung nasa libro ni B. So, debit JO cash. Tapos, joint operation account, naka-credit na 390. Tapos, payable to A na 105. And then, payable to C na 200. Ito po, itong payable to A and payable to C, personal accounts po yan. So, additional info.
The profit was divided equally and B's share was 140. B took the unsold inventory. Ibig sabihin na ang share ni B sa profit ay 140 at yung cost ng hindi na itindang inventory is naka-charge daw kay B.
So, requirement, compute for the cost of the unsold inventory. Gamit tayo ng joint operation account, yung T account. Sabi doon, meron daw credit na joint operation. So, sa ating T account, 390 na credit balance before closing. Tapos unsold merchandise. Yan yung hinahanap natin. Sabi doon sa additional info na si B daw ay merong share sa profit na 140. Divided equally yon. So, 140 multiplied by 3. So, merong profit po ang joint operation na 420. So, i-squeeze na po natin yan. So, 420, less natin yung 390. So, meron siyang unsold merchandise na 30 pesos. So, ganyan lang yan. Diyan sa reconstruction of T account, unsold inventory. So, next is interest in a joint operation whose activity constitute a business. An entity that acquires an interest in a joint operation whose activity constitute a business shall account for its share as a business combination. So, ibig sabihin lang yan na hindi na po natin i-apply ang PFRS 11, kundi PFRS 3 na po ang ating i-apply, which is the business combination. So, example,
Case number 1, A owns a balut business while B owns Penoy business. A and B agreed to combine their businesses to jointly operate a balut and Penoy stand in the upcoming festival. So it means po na meron na sila existing businesses. At yun po yung kinontribute nila to form a joint operation. So, ibig sabihin, A and B shall account for their respective shares in the joint operation as a business combination na po, not PFRS 11. Case number 2. A and B are the joint operator of a balut and Penoy stand. They agreed to admit C as a co-owner for an investment of 50,000. So, it means po, C acquire an interest in an existing joint operation whose activities constitute a business na po. So, ibig sabihin, C shall account for its share as a business combination na. So, kapag existing business yung kinontribute mo to form a joint operation, or you acquire an interest in a joint operation whose activity constitute a business, then you shall account your share as a business combination and not a PFRS 11 na po. That's all for joint operation. The next topic will be joint venture and that will be reported by Janelle and Ronaldo. Ara, ara. Sayonara.
Okay, so joint venture. It is a joint arrangement whereby the parties that have joint control of the arrangement have rights to the net asset of the arrangement. So, kung yung joint operation is meron kang right to the asset or obligations for the liability, sa joint venture naman, wala kang specific right doon sa specific assets or specific obligation doon sa specific liabilities. Rather, meron kang rights dun sa net asset as a whole. Remember, sa net asset lang po siya may rights. So, ang tawag mo dun sa parties ng isang joint venture is joint venturers. So, a joint venture shall recognize its interest in a joint venture as an investment and shall account for that investment using the equity method in accordance with PAS 28, investment in associates and joint venture. So obviously, i-account natin ang joint venture under PAS 28 using yung one-line consolidation method or yung tinatawag na equity method. So bakit tinawag na one-line consolidation to? Kasi isa lang yung account na mini-maintain mo or ina-adjust mo sa movements ng equity ng joint venture mo. So, equity method. Equity method is initially recognized at cost and subsequently adjusted in the investor's share in the investees' changes in the equity. Saan siya may share? Sa profit or loss, sa OCI, sa dividends, and then may result of discontinued operation. Now, if there is profit or loss, the share in profit will increase the carrying amount of the investment in joint venture, but the share in the loss will of course decrease the carrying amount of the investment in joint venture. If there are dividends naman, the dividends will decrease the amount of investment in joint venture. If there is other comprehensive income such as revaluation of property, plant, and equipment, foreign exchange translation differences, etc., the share in the gain will increase the carrying amount of the investment, but the share in the loss will decrease the carrying amount of the investment. If there are discontinued operations, the share in the gain will increase the carrying amount of the investment in joint venture, but the share in the loss will decrease the carrying amount of the investment in joint venture. So illustration 1. On January 1, 2020, the real estate companies, the parties Packet Company and Sackett Company, set up a separate vehicle, Harrison Company, with the purpose of acquiring and operating a shopping center. The contractual arrangement between the parties establishes joint control of the activities that are conducted in Harrison Company. The main feature of Harrison's legal form is that the entity, not the parties, has right to the asset and obligations for the liabilities relating to the arrangement. These activities include the rental of the retail units, managing the car park, maintaining the center and its equipment, such as lifts, and building the reputation and customer base of the center as a whole. As a result, Packet Company paid $1.6 million for 50,000 shares of Harrison's voting common stock, which represent a 40% investment. No allocation to goodwill or other specific account was made. The joint control over Harrison is achieved by the acquisition, and so Packet applies the equity method. Harrison distributed a dividend of 2 pesos per share during the year and reported net income of 560,000. And for the requirement, journal entries in the book of Packet Company. So, sabi natin, di ba, pag joint venture, definitely it is accounted for under the equity method. So, pag equity method, ang entry mo kapag initial investment is debit to investment in joint venture and credit to cash for 1.6 million. Then the receipt of dividends will be reduction ng investment kasi di ba kapag naka-receive ka ng dividend, parang return of investment mo yon under the equity method. So meron siyang 50,000 shares times 2 pesos per share. Meron siyang 100,000 na na-receive. So ang entry dyan is debit to cash and credit to investment in joint venture, the 100,000. And for the share in net income naman, kapag nagka-income si joint venture, meron kang increase sa investment in joint venture. So ang magiging entry natin dyan is debit to investment in joint venture and credit naman sa income from joint venture na 224,000, which is computed as 560,000 times 40%. Yung 40%, yun yung share ni Packet, and yung 560,000 naman, yun yung net income na given.
So let's go to the illustration number 2. On January 1, 20X1, ABC Company entered into a joint arrangement classified as joint venture. ABC acquired its 30% interest in joint venture incorporation for 500,000. So yun yung consideration, yung 500,000. During the year, JV Incorporation reported 1 million profit and other comprehensive income of 1,200,000. JV Incorporated declared a dividends of 600,000. So the requirement for this illustration is compute for the carrying amount of ABC's investment on December 31, 20X1. So the solution would be like this. So first is let's get the initial investment, which is the 500,000. Yun yung consideration. Second one is the share in profit. So it's 1 million times 30% of it, which is the interest, is 300,000. And the next one is the share in other comprehensive income. It's 200,000 times 30% equals 60,000. So ang gagawin natin dito is these items are on the debit side, while the dividends, it's 600,000 times 30%, which is the interest, it's 180,000. Yung dividends, nilalagay siya sa credit side because it is deducted and it's construed a return of capital. So ang carrying amount, it's on the year end is 680,000. And let's go to the illustration 3. Entity X obtains joint control over a joint arrangement for an investment of 220,000. So the investment gives Entity X 40% interest on the net asset of the arrangement. The joint arrangement earns profit of 800,000 and distribute earnings of 500,000 to the owners. So let's compute for the carrying amount of the investment at the year end. So the solution would be like this. So the initial investment, it's 2,200,000. And the share in profit, it's 800,000 times the interest, which is 40%, it's 300,000. So those items, initial investment and share in profit, are in the debit side. Well, again, the dividends, it's 500,000 times 40%, it's 200,000. Kaya, di ba, it is deducted again sa carrying amount kasi nga it's a return in capital. So, the carrying amount, it will be 340,000 for the year end of the illustration number 3. So, let's go to the next slide. And that is the presentation and statement of the financial position. So investment accounted for under the equity method are presented as non-current assets. Sa non-current assets siya makikita, except when they are held for sale. So under PFRS 5 na siya pag ibebenta na siya, pag held for sale na. So next slide again. So let's go to the transaction between the joint venturer and the joint venture. So gains and losses resulting from upstream and downstream transactions between an entity, venturer or the investor, and the joint venture are recognized in the entity's financial statements only to the extent of unrelated investors' interest in the joint venture. So pag downstream transaction ay it provides evidence of a reduction in the net realizable value of the asset na to be sold or contributed. So, if there is a loss, yung loss na yun, ma-recognize in full ng investor. Sa investor lang siya. While on the other hand, when upstream naman siya, yung transaction na yun is about sa nag-provide ng evidence of a reduction in the net realizable value. Yung investor shall recognize ng share ng losses the investor shall recognize its share in the losses. Yung mag-share sila doon sa loss. So, next slide. So, let's go to the exemption from applying the equity method. Siyempre, kailangan may exemption. An entity need not apply the equity method to its investment in associate or a joint venture if the entity is a parent that is exempt from preparing consolidated financial statements if the following conditions apply. First is the entity is a wholly owned subsidiary or a partially owned subsidiary of another entity and its owners, including those not otherwise entitled to vote. Letter B, the entity's debt or equity instrument are not traded in a public market. So the public market can be a domestic or a foreign stock exchange. It can be an over-the-counter or it includes local and regional market. Letter C, The entity did not file nor its not process of filing its financial statements with the securities or other regulatory organization for the purpose of issuing any class of instruments in a public market. Letter D, the ultimate or any intermediate parent of the entity produces financial statements available for public use that comply with PFRS in which subsidiaries are consolidated or are measured through the fair value through profit of loss. When an investment in associate or a joint venture is held by or it is held indirectly through an entity that is a venture capital organization, including investments linked insured funds, the entity may elect to measure investments in associates and joint venture at fair value through profit or loss in accordance with PFRS 9. So let's go to the joint control is loss. An entity shall discontinue the use of equity method from the date when its investment ceases to be an associate or a joint venture as follows. Letter A, if the investment becomes a subsidiary, the entity shall account for its investment in accordance with PFRS 3, business combination, and PFRS 10. Letter B, if the retained interest in the former associate or joint venture is a financial asset, the entity shall measure the retained interest at fair value. The fair value of retained interest shall be regarded as its fair value on initial recognition as a financial asset in accordance with PFRS 9. So the entity shall recognize in profit or loss any difference between number one, the fair value of any retained interest and any proceeds from disposing of a part interest in the associate or joint venture. And letter B, the carrying amount of the investment at the date the equity method was discontinued. Let's go to the letter C. When an entity discontinues the use of equity method, the entity shall account for all amounts previously recognized in other comprehensive income in relation to that investment on the same basis as would have been required if the investee had directly disposed of the related assets or liabilities. Next slide. So for the disclosure in the PFRS 11, there are no disclosure na specified for the PFRS 11. Instead, yung PFRS 12 naman, yun yung disclosure of interest in other entities, yun yung nag-outline ng disclosure required.
The next presenter will be Alessa Minoy to discuss the SME accounting for joint venture.
SME accounting for joint venture. Joint ventures. Joint control is the contractually agreed sharing of control over an economic activity and exists only when the strategic, financial, and operating decisions relating to the activity require the unanimous consent of the parties sharing control, the venturers. A joint venture is a contractual arrangement whereby two or more parties undertake an economic activity that is subject to joint control. Joint ventures can take the form of jointly controlled operations, jointly controlled assets, or jointly controlled entities. Jointly controlled operations. The operations of some joint ventures involve the use of the assets and other resources of the venturers rather than the establishments of a corporation, partnership, or other entity or a financial structure that is separate from the venturers themselves. Each venturer uses its own property, plant, and equipment and carries its own inventories. It also incurs its own expenses and liabilities and raises its own finance, which represents its own obligations. The joint venture activities may be carried out by the venturer's employees alongside the venturer's similar activities. The joint venture agreement usually provides a means by which the revenue from the sale of joint product and any expenses incurred in common shared among the venturers With respect to its interest in jointly controlled operations, a venture shall recognize in its financial statements the assets that it controls and the liabilities that it incurs, and the expenses that it incurs, and its share of the income that it earns from the sale of goods or services by the joint venture. Jointly controlled assets. Some joint ventures involve the joint control and often the joint ownership by the venturers of one or more assets contributed to or acquired for the purpose of the joint venture and dedicated to the purpose of the joint venture. With respect to its interest in a jointly controlled assets, a venture shall recognize in its financial statements its share of the jointly controlled assets, classified according to the nature of the assets, any liabilities that it has incurred, its share of any liabilities incurred jointly with the other venturers in relation to the joint venture, any income from the sale or use of its share of the output of the joint venture, together with its share of any expenses incurred by the joint venture, and any expenses that it has incurred with respect to its interest in the joint venture. Jointly controlled entity. It is a joint venture that involves establishment of a corporation, partnership, or other entity in which each venture has an interest. The entity operates in the same way as other entities, except that a contractual arrangements between the venturers establishes joint control over the economic activity of the entity. Measurement. A venture shall account for all its interests in jointly controlled entities using one of the following: the cost model, the equity model, and the fair value model. Cost model. A venture shall measure its investments in jointly controlled entities other than those for which there is a published price quotation at cost, less any accumulated impairment losses recognized in accordance with Section 27, Impairment of Assets. The investor shall recognize distributions or dividends received from the investments as an income without regard to whether the distributions are from accumulated profits of the jointly controlled operations. A venture shall measure its investments in jointly controlled entities for which there is a published price quotation using the fair value model. Fair value model. When an investment in jointly controlled entity is recognized initially, a venturer shall measure it at transaction price. Transaction price excludes transaction costs. At each reporting date, a venturer shall measure its investments in jointly controlled entities at fair value, with changes in fair value recognized in profit or loss. A venturer using the fair value model shall use the cost method for any investment in a jointly controlled entity for which it is impracticable to measure fair value reliably without undue cost or effort. Equity method, same in accounting for joint venture, which was discussed earlier by Ms. Urbano. On initial recognition, the investment in a joint venture is recognized at cost and the carrying amount is increased or decreased to recognize the venturer's share or profit or loss. Distributions received from the joint arrangement reduce the carrying amount of the investment. Adjustments to the carrying amount may also be necessary for changes in the venture's proportionate interest and the joint arrangement arising from the changes in the joint arrangement's other comprehensive income. Such changes include those arising from the revaluation of property, plant, and equipment, and from foreign exchange translation differences. The venturer's share of those changes is recognized in its comprehensive income. Example, cost model and fair value model. On January 1, 2019, entities A and B each acquired 30% of the ordinary shares that carry voting rights for 300,000 at a general meeting of shareholders of entity Z. Costs incurred in acquiring the shares amounted to 4,000. Entities A and B immediately agreed to share control over entity. For the year ended December 31, 2019, the entity Z recognized a profit of 400,000. On December 30, 2019, entity Z declared and paid a dividend of 150,000 for the year 2019. On December 31, 2019, the fair value of each venture's investment in entity Z is 425,000. However, there is no published price quotation for entity Z. Cost model. Under the cost model, the following entries in the books of the venturer are to be made. January 1, 2019, debit investment in joint venture amounted to 304,000. Credit cash amounted to 304,000. Nakuha ang 304,000 in 30% of ordinary shares amounted to 300,000 plus costs incurred in acquiring shares amounted to 4,000. Note that the transaction cost is capitalized as part of the cost of the investment, similar to the equity method. The journal entries in December 31, 2019, cash amounted to 45,000. Credit dividend income amounted to 45,000, computed as 150,000 times 30%. Under the cost method, the venture's income to be recognized is a dividend received, whether it comes from pre-acquisition or post-acquisition earnings. Under the equity method, dividend received is a liquidating dividend and therefore deducted from the investment account. On December 31, 2019, the venturers must report their investment in entity Z, a jointly controlled entity, at 304,000. Each venture must also consider whether there are any indicators that its investment is impaired, and if so, conduct an impairment test in accordance with Section 27, Impairment of Assets. In this case, wala siyang impairment loss because the fair value exceeds its carrying amount. Assume that the fair value of the respective investment on December 31, 2020 is 275,000 and the estimated cost to sell is 5,000. The recoverable amount, therefore, is 270,000. In this case, the impairment loss should be recognized under the cost model. The entry to record the impairment loss is debit other expense impairment loss amounted to 34,000. Credit investment in joint venture amounted to 34,000. The computation is carrying value before impairment amounted to 304,000 less recoverable amount, which is 275,000 less 5,000, amounted to 270,000. Impairment loss is 34,000. In the statement of financial position on December 31, 2020, the investment in joint venture will be shown at 270,000. Fair value model. Assume that there is a published price quotation for entity Z. The following entries are to be made under the fair value model. January 1, 2019. Debit investment in joint venture amounted to 300,000. Credit cash amounted to 300,000. Debit expense amounted to 4,000. Credit cash amounted to 4,000. Note that the transaction cost is charged to expense. It is not included in transaction price. In December 31, 2019, debit cash amounted to 45,000. Credit dividend income amounted to 45,000. Debit investment in joint venture amounted to 125,000. Credit gain on investment fair value adjustment amounted to 125,000. The computation is fair value on December 31, 2019 amounted to 425,000. Less carrying value before adjustments amounted to 300,000, so the gain is 125,000. On December 31, 2019, the venturers will report a 425,000 value in their statement of financial position. Assume that the fair value of the respective investments on December 31, 2020 is 275,000 and the estimated cost to sell is 5,000. The recoverable amount, therefore, is 270,000. In this case, it is not necessary to recognize the impairment loss because the investment is to be adjusted at fair value. The entry to record the loss on fair value adjustment is debit. Loss on investment fair value adjustment amounted to 150,000. Credit investment in joint venture amounted to 150,000. So the computation is fair value on December 31, 2020 amounted to 275,000 less carrying value before adjustment amounted to 425,000 and the loss is 150,000. Note, through the venturers, each elected the cost model as their accounting policy for investments in jointly controlled entities. They account for their investments in Entity Z using the fair value model because Entity Z has a published price quotation. And that ends my report. Thank you for listening.
So that ends our presentation for today. I hope you learned something from us. Thank you and God bless future CPAs.